Hello everyone and welcome. My name is Jan Doubles and in this class I will teach you 4 steps on how to retire early. And I'm going to do that by showing you the same investing principles that are used by the greatest investors of all time. So you can use them in your own investing strategies. But first, a quick introduction. My name is Jan Doubles and I'm into financial markets since 2008. In this time, I have seen several bull markets and spectacular market crashes. I started my journey just before financial crisis of 2008 and was so-called first-hand witness to full-scale market panic both then and in March 2020 and the euphorias that eventually followed. So I've been here long enough to see many one-time stars, quick buck artists and simply fools that wants to get fast and easy money. And guess what? Once markets make their first signs of trouble, they are all gone. The only ones that survive and actually make money are the ones with long-term plan and ability to stick with it. And this is precisely what I'm going to show. So, here's what you will learn. How to make money regardless of market type. How to increase your wealth while others are panicking. How to be immune to hot tips, useless news and fake forecasters. You will see how does investment plan for wealthy retirement actually looks. What are best passive income strategies in stock and fixed income markets, and by then you will know how to build your own retirement portfolio. And this will be based on the best and most robust investing concepts of all time. Now you might be asking why this is important for you, so hear me out. Most that you have learned and know about investing is dead wrong. Firstly, hot stocks are not worth chasing. They are already risen in 90 and in 99 times of 100, their value is no longer there. Secondly, do not try to time market. Actually, no one has ever made any money by doing so. Thirdly, state of economy is not that important either, because there will always be uncertainty, inflation, fears of recession, and so on. Investing is entirely about something else. Good investing is about the ability to consistently grow your capital. But before we start, you have to understand if this class is for you. If you are someone that wants to understand fundamental principles of investing, this is for you. If you are trying to improve your investing skills but lack a clear set of rules, then this is for you. And if you want to invest without the need to check markets or the state of economy, this is for you. If you want to be able to find opportunities and make money when markets are collapsing, then this is for you. If you have problems with consistency and you are jumping from one strategy to another and eventually cannot make any real money, this is for you. If you are worried about the quality of your holdings and fear that they will underperform forever, this is for you because you are going to discover ways how to avoid that. And I also want to give you some clarification. There are no sure things. Hot stocks won't make you any money and penny stocks are not investment, it's closer to fraud. And there are not such things as guaranteed results. Most of the people lose money in investing, and I cannot give you any guarantees that you won't be one of them. Now, before you turn off this class, let's step back. Reality is that financial markets are full of scammers, snake oil salesmen, and other parasites, so it's very easy to get confused and lost, especially for beginners. And all of the best investors have their fair share of losses. And truth to be told, each investor is in its own unique position, because investing skills cannot be inherited or given away as a title. This is the art that can only be crafted by us ourselves. But once we know how to master it, it stays with us forever. Actually, my own story started in very familiar fashion to many other young traders and investors. As a kid, I wanted to be rich, and in my mind, financial markets was the best place that could satisfy my ambition. So I was really hooked into financial markets. And at that time, I considered Warren Buffett as a role model, since he was self-made and became wealthy by investing and not by creating high-tech companies or had any high connections to the government. So I read his biography, Warren Buffett Way, Peter Lynch, One Up on Wall Street, and books by two Warren Buffett mentors, Benjamin Graham, Intelligent Investor, and actually I had this book as audiobook in my first car, and Philip Fisher's Common Stock and Uncommon Profits. And by following their advice, I tried to read as many annual reports as I could. So I downloaded literally hundreds of annual reports of largest companies that I knew at the time, which mostly were from S&P 500 leading companies. And I also made my stock simulator with my own subjective growth and value criteria, which I then used as screeners for my potential winners. And I also kept their financial ratios in my own homemade Excel spreadsheets. But at that time, I also started to trade and somehow put my investment effort aside. I also tried to make additional business and make additional income outside of financial markets. And somehow I didn't invest for a long time, and all my early efforts went nowhere. In hindsight, I made a simple mistake. I always thought I would invest when I will have free money and then my returns would be more substantial. But actually, free money is a matter of priorities. You can always put aside some money for your investments. For your investments. And after a while, I deeply regretted my wasted years. Not only I could have invested earlier, but also that time was the best time when to start. Little did I know, back then I started my investment career, at the beginning of greatest bull market in history. After markets had risen, I tried to outsmart markets twice and claimed that bull markets ended, but I failed miserably. Not only my forecasts did go wrong, but the markets came back much stronger. If only I were able to stick to my bluntly simple investing plan that I created just as I started, I would be able to make killing for years. And I didn't actually needed much money, just a starting capital with a few $1,000s that could be increased by each month or quarter, and compounded interest will do the magic. So, after much thinking, I reorganized my life. I restructured my assets, and a few years ago I decided to allocate constant sum of my earnings to my investments in stocks and mutual funds and ETFs. I took out my original investing plan, updated it, and based on that I made proper investing plan. And to diversify my income, I found an investing consulting company. In that way, I'm able to invest and not to make money out of markets. Not to take money out of markets, so that my returns are compounding and my commission costs and taxes are minimal. So now I will show you the actual steps to successful retirement. Step 1. How to make retirement plan. Step 2. How to choose winning ETFs. Step 3. How to choose best bonds. Step 4. How to grow your portfolio. So let's start with the first thing, retirement plan. Before you start, you have to answer 4 quick questions. What are your retirement goals? What's your current financial situation? What's your risk tolerance? And how much time you have for investing? So, what are your retirement goals? You have to know what actually you want to achieve, because any investment strategy is as good as the long-term financial goal it wants to achieve. The more precise your goals, the higher the chances of actually achieving them. And your goals have to be realistic. Oh, it sounds rather obvious, but most people miss it. You have to realistically assess your debts, savings, income, and returns that are possible. Make numbers that match your spendings and your lifestyle. But if you want to have significantly more, you have to know how to pull that off. And think of unexpected expenses. As we get older, we need to spend more and more on medicine, health, and stuff that didn't bother us in our early adulthood. And all these have to be taken into consideration. And have a margin of safety. Remember, there might be unknown unknowns. There could be times where you won't be able to invest, and there could be times where you have to do extra spendings. Be prepared for that and plan for something for a rainy day. So next logical question is, what's your current situation? Now this is critical. If you are struggling to pay for groceries and you are borrowing money to give another loan, you probably should make your budget in place. You should never ever invest from a desperate financial position. You should only use funds that you are able to save. And your pension funds will be locked for years, so be sure that you have additional income streams that support your daily expenditure. So next thing, what's your risk tolerance? No matter how smart it seems, but investing will always involve some risks. And at some point, your holdings will be at loss. So, you have to be mentally prepared for that. Remember, the stock market could fall more than 30% at any given time. And are you able to withstand years of underperformance? And also your age matters. The older you are, the less tolerance for risk you could afford. If you are young, you could invest 100% in stocks. But as time goes by, you should rebalance to fixed income or other less risky securities. How much time you have for investing? Investing requires both time and energy. This is not a part-time hobby. Active investing requires as much time and energy as any business or serious profession. And if you don't have time for that, you have to create a passive investing plan. Make sure that your strategy fits your time schedule. Your investing plan has to be usable in real life. Otherwise, you will just drop it. With that said, let's start with the main part of this class, how to create winning retirement portfolio. At first, you should know, the first thing that you should do is not to make dumb mistakes that would cost you a lot of money. Do not chase hot stocks. Hot stocks are already risen, and in 99 times of 100 they are significantly overvalued. Do not follow tips. You don't know why someone is suggesting something. He might have a completely different situation than yours. His tip will be meant for short-term or intraday trading, but if you are a long-term investor, this tip will only be counterproductive, and his win could be your loss. And do not put all your money in one instrument. If you are holding one instrument, your fortune will be tied to fate of that, and with that, anything could happen. Just simple diversification will significantly reduce the risk of bad and unforeseen events that could destroy that one company. And actually, insiders and so-called they have much less power than you think. Stock manipulation and insider trade have had limited short-term impact even before there was any stock market regulation. So a simple fact of the life is that everyone is subject to market forces, and at the end, market prices will reflect companies' fundamentals. So, what to do to avoid that? Actually, there are quite a few things that might help. When investing, ignore macroeconomic factors. This is the economic situation in certain region or country, and it's not particularly important unless there are real risks of nationalization or strong capital controls. The performance of some specific sectors is also not that relevant. There always will be winners and losers, and eventually they will balance each other out. Therefore, it's more useful to spend your energy to look at the larger picture, diversify wisely, balance your probabilities, and let your capital grow. So rather than trying to outsmart professionals in their own game, it's more likely that you will outperform them by simply following indices. In that way, you will have way more chances to build your wealth. Once this is clear, we can finally start to talk about our favorite topic, how to create winning portfolio. And here is the secret. The best, safest and easier way to grow your capital is to invest passively by using dollar cost averaging. The essence of this approach is to buy the whole stock market index and to mimic returns of that index. One good reason why this approach makes sense is that historically the markets have returned around 10% per year. This return has been used as a reference point to any possible investment strategy throughout financial markets. Another good reason why this approach makes sense is that there have been countless of examples that this actually works. Here are just some of the facts. There are countless examples which clearly indicate that most mutual fund and hedge fund managers cannot beat stock market index. And if you calculate management fees, their performance is even worse. And as a group, retail traders and investors perform even worse. Statistics show that the average retail investor actually loses money. So hence, if you simply just go and copy a return of general markets, you are building a solid base of your investing portfolio. Your returns will be around global benchmark, and in the long term, you will do better than most professionals and much better than amateurs. But before we go further, I have to give you some caution. There could be months or even years when markets don't perform at all. And if you are here for long term, these periods will come and you must be prepared for them. Most of the time, this will be really boring. You simply have to do nothing at all. And this will take some time. While this is almost a certain way to get rich, it won't happen overnight. So, here are a few things that you have to know about this approach. You still have to know which funds to follow. There are hundreds of different stock indices that you can follow. Stock indices might not be the worst place to invest, but it's certainly not the only place where to invest. Assets like bonds and other investment-grade fixed income securities, stock and commodity ETFs and other assets clearly provide some investing options. So it's very easy to get stuck if you don't know what and where to start. So first things first, which indices you are going to follow? Will you simply buy ETFs that follow some of the largest American stock indices and stock ETFs? Will you invest in other stocks and ETFs as well? There are countless possibilities to passively invest in any stock market that you like. Here are just a couple of examples of your possibilities. You can buy ETFs that follow stable companies that have long history of high dividend yields. You can buy ETFs that follow specific sectors, such as energy sector, technology sector, financials, and everything else. You can buy ETFs that follow certain size of companies. For instance, you could buy ETFs that follow small cap stocks with high growth rates. So instead of following whole market, you simply can buy a fund that follows specific criteria. You don't have to do any stock picking and portfolio building yourself. Everything is done for you. This option doesn't guarantee higher return, but they certainly could provide you with more options. You might have some personal reasons why you invest in whole index, so you can have a portfolio that have only these sectors and stocks that you like. You can diversify between broader stock indices and specific sector that you like. You can invest in several stock indices and several sectors as well. Now, when and how to do that? Remember, market timing goes against fundamental principle of investing. You are not trying to outsmart the markets. You are trying to mimic market returns. You are not here to follow trends, buying at price discounts and whatnot. You are not a trader. Prices can go to extremes. There have been countless examples where markets have been irrationally under or overpriced. And there is a legendary quote from Keynes himself: markets could stay irrational longer than investors can stay stolen. So in reality, there is no best time to invest, but there is one way how to mitigate this market risk, and it has been used successfully by investors for decades. It's called dollar cost averaging. What does it mean? In a nutshell, dollar cost averaging means that you simply are allocating one particular sum each week, month, or any other time period. Time has shown that this is the best way to average out all market fluctuations. So instead of trying to guess if market is overpriced or at a bargain, you simply constantly invest and let the odds play out in your favor. Now let's put this together and have a couple of practical examples. How does index investing in combination with dollar cost averaging look like? Here are two scenarios: S&P 500 and Nasdaq, which are deliberately oversimplified. And of course, excuse me for my simple chart. The S&P 500 is leading stock market index. In late 2016, the whole market was hit hard out of nowhere because Trump won the election, but consequently it bounced back and in following years made a killing. And look at Nasdaq, how it performed after depths of COVID crisis. It also was hit as hard as the whole world was collapsing. But given the strong growth of tech sector, not only it bounced back, but continued to outperform broader indices. Now let's have a closer look to other ETFs. Nowadays they could track almost anything. And as we talked before, they pretty much can give you full exposure to stock market without breaking a sweat. But this is not all. By using ETFs correctly, you could take advantage of all major asset classes. So here are opportunities in ETFs. By buying commodity ETFs, you can get exposure to all major commodity markets and make direct money on all price rises in commodities. By buying so-called tail risk ETFs, you could actually make money while stocks are falling. Idea behind this is that they are shorting the major stock indices. So there is enough opportunities not only to protect yourself, but to make money when everything else is falling. So, what could be considered good and safe investment in stock ETFs? Well, as I told before, history has shown that low-cost index funds should serve as a basic reference point for any investment. Also, there are many good ETFs that could give you exposure to particular markets and industries with minimal risk. For instance, if you want to invest in commodities and are not yet familiar with industry, commodity ETFs should be a good starting point. I showed those examples just to make a point, and that there are times when you could capitalize on opportunities that markets are giving us. And obviously, things are not that simple. You simply cannot buy indices, just because they have fallen more than they should and think that they will bounce back next week. If it were so simple, then anyone would be rich. Therefore, in order to balance these probabilities, we should diversify. The world is so uncertain that no sane investor will ever invest all his holdings in one index fund. So the best way to balance these risks is to diversify and across structurally different sectors and industries. So, as a rule of thumb, the best middle ground is between 3 and 5 sectors and industries. Invest in too few and you'll have exposure to and fade to only one index. Invest in too many and you'll be better off by simply investing in one index fund. So here is how stock index portfolio would look like. 2 major indices. These would be established indices with strong credentials such as S&P 500, Dow Jones Industrial Average and Nasdaq. 1 or 2 stock ETFs of high dividend paying companies. These would be specific stock ETFs who track stocks that have good history of stability and dividend payments. And 1 or 2 stock ETFs that have potential to be proverbial 10 baggers, or in other words, ETFs with companies who have potential to make 10-fold price increase. These companies would be fast growing and have a realistic potential to have enough growth to justify multiple increase in their market cap. So we have covered basic principles on successful stock index investing. Now I'll give you a quick look at other financial products. Let's start with fixed income securities in today's market. For long term, bonds were dead. The real returns were close to zero or even negative, but with rise with interest rates, they are showing promising returns. Returns on United States Treasuries have risen to levels that they had before money started to print by central banks. This means that they could actually get investment grade securities that earns more than 5% interest. Lower grade bonds, they pay higher interest rates, but they shouldn't be considered as backbone of your portfolio. Yes, you could get up to 10% coupon, but it comes with risk. Here we are not talking about distressed securities. This is a separate sector that requires individual discussion. And as a rule of thumb, your exposure to bonds has to depend on your risk tolerance. If you have high risk tolerance, you can invest most of your portfolio in stocks. But as older you could get, your exposure to investment grade bonds should gradually increase. So 60% of your typical bond portfolio should consist of investment grade bonds and 40% of lower grade bonds. And once you get older, this proportion should change only to investment grade bonds. With that being said, let's talk about financial products. Now we could invest almost everywhere we like at very low cost. Here are just a few examples. Crowdfunding. It gives us almost anyone opportunity to invest directly in social projects, startups, business projects of any type that you like. In most cases, you have a chance to invest in fixed income equity or some sort of hybrid model. There is much more. Trading in futures, forex, options, and crypto, and so on. But here are some words of caution. Not all of them could be considered safe investments. The vast majority of crowdfunding and P2P products stand between penny stocks and junk bonds. Forex, futures, options, crypto, and social trading is trading, not investing. If you can find safe crowdfunding, P2P, and P2P options, consider them as an alternative for lower grade bonds. And now we can actually look what real portfolio would look like. Remember, investing is not about picking best stocks or funds. It's about maximizing your winners while minimizing your losers. There are no clear-cut 100% precise ways how to build your portfolio. And most known portfolio theories are not actually that good. For instance, famous modern portfolio theory will be worse than index investing. Portfolio building. When you are building your portfolio, use just one simple promise. No one has any clue about market trends, and at short term, you don't know which funds or products will rise, which will fall. So well-balanced portfolio should even out these probabilities. And to do that, the best thing would be to divide your capital between different types of investments. In order to do that, firstly, you should know how much to invest in index funds and ETFs. You should keep around 50% to index funds and stock ETFs. Your ETFs should be balanced between stock index ETFs, dividend stocks, value ETFs, and growth ETFs. Once that is settled, you should know how much to invest in bonds and other ETFs. You can easily invest up to 30% of your portfolio in investment grade bonds. Keep around 10% of your portfolio in alternative investment ETFs, like ones that follow, for instance, commodities. And how much you need for fooling around? If you have high risk tolerance, you can leave 10% of high yield, high risk crowdfunding or P2P projects. However, I won't recommend putting these investments into retirement portfolio. Instead, make separate investment strategy with funds that you can afford to risk. So, what would real portfolio look like? Here's the chart. You could see how you could stack 10,000 euro portfolio between different investments which we described earlier. So I will give you 1 minute to look at it and make your own conclusions, how you feel about it and how could you realistically create that for yourselves. Nothing fancy, right? So let's move on. Having the right approach and discipline is the way you can realistically make money. This is a practically foolproof way to make money consistently over the years. So listen, here are some things that are probably true about you. You know that in long term investing is one of the best ways how to consistently grow your capital. And you are someone who has great will and determination to make enough money for retirement that you want. And obviously, these investing principles that I was showing you does work. If you don't believe me, well, look at the successful investors that have made money in markets with them. So here's just a fraction of them. Warren Buffett, Benjamin Graham, Peter Lynch, Charlie Munger, and Bill Ackman. Now, here's a little comment to these investors. I didn't just go to Forbes list and took 5 random hedge fund billionaires and made some vague claims. These investors I mentioned have given interviews and explained their investing process in detail. In addition to that, these investors are the investors that have invested in the way that's relatable to what I'm teaching. That is, they make money by investing, using value investing and also passive investing as well. And that's why I could say with confidence that the principles that I'm showing you are indeed based on the ones that are used by top investors and hedge fund managers. So it's pretty sure that if you use this approach, it's probably going to do well for your investing. But what might be the best way and the fastest way for you to implement all these principles that I just showed you? Well, for that I created JD Retirement Strategies. This course is specifically designed to help you create your retirement goals, find best investments with best returns and create investment portfolio that will make you money. So if you don't want to be dependent on market fluctuations, if you don't want to be dependent on market forecasts, if you want to get rid of gurus, lame tips and penny stock rooms, if you want to spend behind screen less than few hours per month, and if you want to retire wealthy, then this is specifically for you. So here's what I have got. I have created a ready-made retirement plan that will show you how to do all that and more. This plan consists of 5 modules. Module 1, retirement planning. Module 2, capital preservation strategies. Module 3, maximum return investing strategies. Module 4, detailed guide on how to build and grow your retirement portfolio. Module 5, course on investing psychology. So let's start with Module 1, retirement planning. Here you will learn essentials for successful retirement. What are steps for successful retirement? What are different stages of retirement planning? What are the most important financial factors that you will need to consider when you retire? Module: conservative investing strategies for maximum security. Firstly, state pension, how to maximize its use. How to invest in annuities and other insurance products. What are the best fixed income opportunities for retirement? Module 3, maximum return strategies, how to create winning retirement portfolio. Firstly, detailed guide on real estate, what and how to choose best investing approaches in real estate. Next, how to choose best dividend stocks and dividend stock ETFs. Next, guide on stock index ETFs. And last, guide to alternative asset classes. Module 4, how to manage your portfolio and grow your capital. First, best retirement investing concepts that work. How to build your retirement portfolio. Next, retirement portfolio management. How to build stock ETF portfolio. How to build income ETF portfolio. Fixed income ETF portfolio. How to choose best alternative investments and management. And when and how to adjust your portfolio as the time goes by. And Module 5, Investing Psychology. Here you will learn how to keep your discipline in check and focus on long-term gains. Firstly, I will show you why investment psychology is that important. Then I will learn you how to deal with FOMO or fear of missing out. Then I will show you how to prepare yourself for eventual market swings. And I will show you how to keep your discipline in check. So here is what all that will do for you. Once you are familiar with JD retirement strategies and know how to use them, you can implement them when you feel ready. Now let me show you the secret ingredient that will make you rich, and that's compounded interest. Well, you know why Warren Buffett doesn't take money out of the markets? Because he reinvests and compounds his profits. That's why he's so rich. Well, in part at least. And if you compound long enough, even small returns could make you a fortune. And even a difference of few percent will make huge difference when investing period has ended. Let me give you a quick example. Let's say we have two scenarios with two investors with the same capital of $10,000. Investor A makes 7% a year and investor B makes 10% a year. Here are their returns after 10 years. Investor A has made $19,600 and investor B has made almost $26,000. So see how only this small 3% difference eventually made huge difference. Difference between those two returns are more than double. So the next great secret I told you was dollar cost average. Let's show you how both of these investors would perform if they invested additional $100 each month. Remember, returns are the same. So investor A will made $36,250 and investor B would have made slightly more than $45,000. And here you could see comparison between all of these scenarios. Investor A with no dollar cost average will be making $19,600. Investor B without using dollar cost average would make almost $26,000, and investor A with dollar cost average will be making $36,250, and investor B with dollar cost average will be making slightly more than $45,000. So see how important this is, the difference between an investor who makes only 3% more and consistently invests $100 each month has made more than $25,000 in just 10 years. This is substantial difference, and you have to understand the importance of these small factors. And this is how you can realistically make money, by having right approach and discipline. Now I will give you some comments on these examples. Markets won't rise all of the time, and at some time markets will fail. And I showed you just to get a point. Here is how money is made, and my strategy will help you to do just that. And this is what I call robust investing strategy. This is why I'm telling you that it can be used almost immediately once you have it. But it also gets even better. I created additional bonus, JD investing tools. I'll give you same tools that I use for my own investment research for you. Firstly, I will give you ETF and mutual fund screeners. This will help you to do most of the legwork and save you hundreds of hours. Once you know what you want, you will be able to narrow down your search to a few chosen funds that meet your criteria. And I will give you a tutorial on how to choose correct broker. Here I will show you the different types of brokers, what are their risks and benefits, and how to actually choose best for you. But we are not done. I'll also add a bonus number 2. I will give you access to my private library. Firstly, I will give you the most important book of investing that's ever written, The Intelligent Investor, and actually other books that define modern investing as we know it. And I will also share you one of the most important trading information that you could have. You will see video lectures and shareholder letters from best investor of our time, no other than Warren Buffett himself. Buffett always has been very frank about his approach to investing, so these video lessons themselves are worth far more than the cost of this course. And last but not least, I will personally invite you to my investing network. There you will meet like-minded investors who share same views, goals, ideas as you do. I know by fact that supportive investing community is essential to success, and you will get just that. We have invested a lot of time in creating this special place where investors can link up with each other, share their best stock picks, investing ideas and more. Members can post polls, articles, questions, updates and more. Plus you can have direct chats with me as well. So you'll have possibility to communicate daily not only about stocks, ETFs and investments, but more importantly, you'll get supportive community that will help you to improve your investing strategy, get over losing stakes and get your investing discipline on check. And on top of that, I will give you my weekly mastermind sessions where I personally will help you to implement your investing strategy and answer to all your questions regarding investing. So here's a glimpse of what you will get. Live market analysis. As you know, investing is an ever-changing environment. You will get my personal insights and analysis regards the latest developments in global economy and major markets and how to potentially make money out of that. Weekly Q&A sessions. I will personally answer to your questions regards investing, market analysis, investing strategies, investing psychology and much more. This will not only help to implement JD retirement strategies, but to help them to trade with, investment discipline as well. And by now you are wondering about the price. Now listen, I used to sell only strategy module for $3,000 and I sold my courses on investing in ETFs and portfolio management separately for $2,000 each. So I believe this course is significantly more valuable than previous ones. And for now I'm selling the whole package just for $2,000. But we made it more affordable. If you buy in next 24 hours, if you want, you could make 2 payments for $597 or save $1,000 and make 1 payment for $997. But it gets better. On top of all that, I want you to understand something. You are protected by best guarantee ever. Here's the ultimate guarantee. You'll have 60 days to check what I'm offering to you, and you have another 60 days to implement it. And if by end of time you decide this is not for you, we will refund your money and you could still keep your access. So here's what you have to do next. Go to my website, choose your payment plan, then we'll give you email with login data. And after that you can register and get full membership access. And your new investment journey could start. So here's the recap what you're going to get. You will get full JD retirement strategies with course on retirement planning, ready-made capital preservation strategies, maximum investing strategies, detailed guide on how to build and grow your investment portfolio, course on investing psychology, bonus number 1, market screener and guide to best brokers, bonus number 2, copy of Intelligent Investor, access to Warren Buffett video lectures and his shareholder letters, and bonus number 3, JD Investing Network. So order now and get huge discount. Make 2 easy payments for $597 or one payment of $997. You are protected by best guarantee ever. You have 60 days to learn it and 60 days to test it. If you decide this is not for you, I will give you 100% refund. But now you have to understand that this is impossible to teach everyone. Therefore, I want to reward people who take fast action and appreciate time with me. And as you see, this offer is not available to general public. So be the one of those few investors that have a chance to have this special price. So you watch this entire presentation. You want strategies and mentoring that makes you money. And you know this is excellent value. Therefore, take advantage of this incredible discount and can lose guarantee now. You have absolutely nothing to lose and everything to gain. And I want you to go to my site and enroll today. So thanks for watching, and I really hope you have great time and insights, and I wish you all the best. And let's meet a bit later in next phase of your investing.